I want you to stop watching mutual fund videos, not because they're bad, but because most of them give you pieces, not understanding. NAV, SIP, index, regular, active, if those sounds like random words stitched together, you're not bad at finance, you were just taught it badly. In the next few minutes, I will explain mutual funds the way they should have been explained the first time. The basics, the tips, and a few perfectly legal things. No tips, no hype, just clarity. Hi, I'm Sanchit Arora, software engineer at Glean, and let's get started. One quick thing before we go on, I'm not here as your financial advisor. I am on my own investing journey too. Everything you will see here is what I have learned through reading, investing and making my own mistakes. This is still a purely educational video. No fun tips, no recommendation. The goal is to help you understand mutual funds good enough so that you can make your own decisions. The topics are somewhat interlinked, so make sure you watch the whole video. So what exactly is a mutual fund? When I started investing, I thought buying a mutual fund is equivalent to buying the market. Turns out I was buying something and didn't even know what. Mutual fund is just a pool of money that is managed by professionals. Now they can buy stocks using that, they can buy debt using that, they can buy gold using that and other things also. So it's just like not putting all your eggs or your salary in one basket. Now let's clear out three things: mutual funds, stocks and FD. Buying a stock means you are picking one company. FD is the old faithful of Indian households. In FD you give the money to bank and they promise a fixed rate of return, roughly around 6 to 7% per annum these days. And in exchange you get stability and predictability. Now mutual fund is not that simple. Just saying mutual fund does not mean anything. It can be equity or stocks, it can be debt which is like FD, it can be gold, a combination of these and a lot of other things. Mutual fund is just a collection of something and that something matters. There is a common myth that mutual funds equal to share market. That's not correct. A related term that you might have heard these days is ETF. I know there are a lot of terms and concepts in this video, so make sure you are noting those down and pause the video as required. Also, if you want detailed video on any of these, do let me know in the comments and I will make one. So ETF is mostly same as mutual fund, just minor differences. ETFs are exchange traded funds. A mutual fund is typically bought or sold directly through the fund house or investment platform at the end of the day price. Note this down, the price is the end of the day. So one single price for one day. And this price is called as NAV. We will discuss this later also in the video. An ETF on the other hand is traded like a stock on the exchange. And you can buy or sell ETFs throughout the market opening time, and the price is determined by the market just like it happens with all other company stocks, and that's why it's called as exchange traded funds. So these are mostly funds that are exchange traded. So in essence, ETF is just a mutual fund that you can trade on exchange. So TLDR is, don't think a lot about ETF or mutual fund. You can buy whatever you want. In general, in India, because ETF is still a new category, prefer mutual fund wherever possible. Now let's come to the types of mutual fund. I will cover the broad 5 categories of mutual funds we have. The first type is obviously equity funds, which mostly people mean when they say mutual funds. So equity funds invest primarily in stocks or companies directly, also called as equity. And they can be further also divided into large cap equity funds, mid cap equity funds, small cap equity funds, flexi cap or multi cap, depending on the size of company they primarily invest in. These can also be sectoral or thematic, focusing on very specific industries like tech, pharma, banking. But my personal advice here is these are very volatile and you are still betting on one specific industry. So maybe just avoid these, because you are going with mutual fund because you want simplicity and peace of mind, so just avoid this is my personal advice. So equity funds aim for high growth but also come with higher risk or volatility. They are generally suitable for long-term goals like more than 5 years, because the short-term volatility or market swings can be pretty wild. You might have seen the COVID crash or the market crash during the US-Iran-Israel war. So in short term they can do whatever they want, but it takes long term to recover from these things. One homework that I want you to do is study about arbitrage funds and ELSS funds, and do mention in the comments on what these two are. Second category of mutual funds is debt fund. They are mostly like FD, so they invest in bonds and fixed income instruments. They aim to give you slightly better returns than FD with less volatility than the equity funds, and also they give you flexibility because these are not fixed, so you can buy or sell them mostly anytime. And there are debt funds for different time horizons and risk levels, starting with liquid funds which are extremely safe, almost like FD, and also give similar return only. Then you have short-term mutual funds, then you have medium-term debt mutual funds, and then you have long-term debt mutual funds. If you are anywhere in your 20s or maybe even early 30s, I don't think you should invest in long-term debt mutual funds, because if it's long-term, better invest in equity only, because that's supposed to give you better returns. Third category of mutual funds which I don't like are hybrid funds. They mix equity and debt in some proportion. It sounds fancy but not really great in my opinion, because they come with higher cost, so you better just do it yourself. It's very easy to invest separately in an equity mutual fund and also separately in a debt mutual funds with lower cost. and it also gives you flexibility so that you can sell specific part of your portfolio. For example, if the equity market is down, you can sell only the debt portion. But if you invest in hybrid mutual fund, you don't have that option to only sell the debt part. You are selling hybrid fund. It contains both equity and debt. So even if you don't want to sell equity, you will have to sell equity because it's part of that. So better just keep those separate, invest equity separately, invest debt separately. Fourth category of mutual funds are index fund. They are actually kind of equity funds only, but worth mentioning separately. Index funds just copy a specific index like Nifty 50, for example. Nifty 50 is the index of top 50 companies of India. The fund manager who is managing your money isn't trying to beat the market. They are just mirroring it. So whatever the result of broader market, in this case Nifty 50 is, that will be the return of your money also. The benefit here is they're at extremely low cost because the fund manager is not really using his brain or whatever. They're just copying whatever the Nifty 50 or any other index is. Again, a practical advice from my own experience: if you're planning to buy large cap mutual funds, those are the funds which are investing in very big companies, you are better off investing in Nifty 50 index only, because most of the mutual funds actually managed by fund manager fail to even beat the Nifty 50 benchmark. So better just invest in Nifty 50 index at extremely low cost. The fifth kind of mutual fund is commodity fund, and as the name suggests, they basically track a specific commodity. It can be gold, silver, oil, iron, and literally anything. Again, my practical piece of advice here: if you want, only invest in gold mutual funds, because gold is like the world level established currency kind of thing. Rest of the things, even silver, are way too volatile and risky, so it's better not to invest there and have a good night's sleep peacefully. Now let's come to NAV, the term I mentioned before. NAV is net asset value. It sounds fancy, but it's just the price of one unit of mutual fund that you are buying. And for all practical purposes, it's useless and mostly just an accounting number. NAV is like your pizza being cut into slices. More slices doesn't really mean more pizza. A lower NAV does not mean a fund is cheap or you got a good deal. It doesn't mean anything in fact. Sure, you will get more number of units, but number of units or NAV does not matter. What matters is the amount you have invested and what's the rate of return on that. The rest of the things are just accounting numbers, useless for all practical purposes. Now let's come to the legal scam of regular mutual funds. Mutual fund can be direct or regular, and in case of regular, you are just paying extra commissions for mostly nothing. They are exactly the same except one part, which is the cost, also known as expense ratio. So the only thing that will change is you will get a lower return if you invest in regular mutual funds. A regular plan means you are investing through an intermediary. This can be some broker, agent, your bank, or some distributor platforms. And the fund house pays them a commission for bringing you on board. So the expense ratio or the annual fee of a regular plan is higher, typically about 0.5% to 1% more than the direct plan of the same fund. 1% might sound less, but in your investing journey of maybe let's say 30 years, 1% can make a huge difference. A direct plan is where you invest directly with the mutual fund company using their website, app, or certain direct platforms with no middleman. No commissions are paid, and this results into lower expense ratio, which means more of the fund returns goes to you. Over long periods, these tiny fee differences create a huge difference in your wealth. So how can you buy these direct mutual funds and not fall into the trap of regular plans? See, mostly these days, all the famous brokers or apps allow you to buy direct mutual funds only. They don't support regular funds at all. Just do a simple Google search of what all brokers are there. They have option of direct mutual funds. I have personally used Grow and Coin by Zerodha. You can find those links in the description if you want to try those out. Unless you absolutely rely on an advisor's guidance, there's no reason to choose regular funds. It's literally the same fund manager, the same company, the same portfolio, just at a higher cost than direct plan of the same fund. Now let's talk about one of the hottest debates in the investing world of active versus passive mutual fund. So the question is, can a fancy fund manager consistently beat index, or you are just better off taking the index returns? Active mutual funds are the traditional mutual funds where a fund manager and their team of analysts actively decides what stocks to pick, or other assets also, because remember I said before, mutual fund is just a collection of something. These can be stocks, different type of FDs or whatever. So this is where the fund manager actually uses their brain to pick different amount of something. Something can be stock, something can be anything. And their aim is to beat the benchmark. For example, if you are investing in a active large cap mutual fund, then the benchmark is Nifty 50 index fund, which is the top 50 companies of India. And passive funds are the index funds and some ETFs, and like I said, they have a very defined rule of what to pick and what not to pick. There's actually another legal scam here, and that's called as closet indexing. It's like paying for a handmade coffee and getting Nescafe. So you're basically paying for something special, but you are getting very standard things. Some active funds charge high fees but they stay so close to index that their returns is mostly the same as index but before the fees. And why would they do this? Because it's safe. The fund manager won't really underperform the index because it's literally just copying it. They can claim to be active but avoid the risk of huge deviation. It's like a student copying 90% of the answer from textbook and just changing a few words to avoid plagiarism detection. If you are a beginner or want a no-nonsense approach, just pick one Nifty 50 fund, one small cap fund, one mid cap fund, and maybe one flexi cap fund also. I've explained this in detail in the only video that you will need to start investing. I will add the link in the description and somewhere here or here also. You can just check that. The bottom line, just don't blindly believe that every active fund will beat the index. Remember, the fund manager's Mercedes EMI is going through your fees. So make sure that they earn it. And as I said before, ETFs are also same as mutual funds only. So this active passive discussion remains same for ETFs also. In India, ETFs are still developing. So most ETFs are passive, but there are active ETFs also in more developed markets like US. Now you decided the mutual fund, but what strategy will you use to invest in it? SIP or lump sum? SIP is basically systematic investment plan where you invest a fixed amount of money every single month. Lump sum is more like one-time investment or basically irregular or ad hoc. Whenever you want, you invest. And remember, both are ways of investing. You don't invest in SIP, you invest in the underlying instrument like a mutual fund. Or I also do SIPs in some certain specific stocks. The benefit of SIP is basically the share market is very volatile with its ups and downs. So you basically keep buying on all the prices to average it out. I would say even if you get some ad hoc thing which can be a one-time bonus or anything, better do it in installments like SIP so that you avoid buying at the highest price possible and then seeing negative returns. So when would lump sum investment make sense? First, when the amount is small. So for example, if you already invest 1 lakh every month, then you got 20,000 from somewhere. There's no point distributing it further. You can just invest it there in that month only. Or if whatever you are investing in, remember again, it's just a way of investing. So whatever you are investing in is less volatile. For example, if you're investing in debt mutual funds, they are not expected to be a lot volatile. So you can invest all your money in a lump sum in one single shot because they generally keep on going up only. Very important, whether SIP or lump sum, the key is to stay invested for long term. SIP is not your shield against loss. If you do an SIP for 12 months and market crashes in month 13, then your portfolio will still go down. But because you invested at different levels, you are still slightly better off than you would have if you bought everything at peak. So you picked the mutual fund you want to invest, you decided what strategy you will use to invest. Now you go onto the platform and see that the same fund has different variations. IDCW with different time frames and also a growth option. So what are these? So equity mutual funds ultimately invest in stocks only, and stocks give dividends. So if the mutual fund variant is IDCW, they give the dividends back to you. If it is IDCW 3 months, they collect all the dividends for those 3 months and then pay you. So every 3 months you will receive a chunk of dividends. If it's IDCW 6 months, then every 6 months you will receive the dividends. The other option is growth. In this case, whatever dividends mutual fund receive from the stocks, they reinvest and buy the same companies they are already buying. So for obvious reasons, growth variant will give you higher returns than the IDCW variant because IDCW is giving you back the money in between. In growth, they are keeping the money and investing in themselves again. I will be honest, the moment dividend hits my bank account, it feels good emotionally. But taxes don't care about emotions. Dividend income is counted as your normal salary income. So for example, if you are in 20, 25, 30% tax bracket, then whatever income you are receiving from that dividend, if let's say 100 income you receive from dividend, it will be taxed at your income tax slab rate. If it's 30%, then 30 will go out of and you will only get 70. If you choose the growth option, they will reinvest in themselves. So you don't pay the tax on that. And later, if you sell that mutual fund, you will only pay capital gain tax, which at least currently is much lower than your income tax slab rates. So again, practical advice, if you are in your 20s, 30s, you don't need a regular income and are earning decent, better always buy the growth variants of any mutual fund you are purchasing. I think now you can delete your mutual fund playlist or at least stop adding the top fund this year videos. But one last thing is about the biggest mistakes beginners make when purchasing mutual funds. First is panic reactions. Research says that the fund returns are much better than investor returns. This is because many investors panic during market falls and either stop investing or worse, pull out the money from the market. Buying high and selling low is kind of the exact opposite of the ideal way you want to invest. You want to buy low and sell high. So the day you want to stop your SIP is usually not the day you should actually stop your SIPs. And second is investing without a goal or a plan. I'm not asking a full plan like buy a car at this age, buy a house at this age, getting married at this age, blah blah blah, because I think these are pretty complicated and useless for someone in their 20s. But you should know what money you will need in less than 1 year, what money you need in, let's say, 3 to 5 year time horizon, what money you will need after 5 years, and then invest accordingly. There is no sense investing in a small cap mutual fund or almost any other equity mutual fund if you want that money in 1, 2 or even 3 years. And as I also mentioned before, not all mutual funds are for long term and volatile. Some are especially for short term needs and are very predictable. And third mistake is chasing the recent stars and doing like, OMG, this fund gave 50% returns last year, let me put all my money in it. Slow down, tiger. Last year's best performer often won't be the next year's best. In fact, it can be a one-time hit and may backfire you very badly. Don't select mutual funds based on flashy 1 year or even 3 year returns. Use the method I have described in my other video, which I mentioned before. Again, I will add it here or here, to select the mutual funds. Fourth mistake is a lack of basic research, especially on taxes and costs. Don't just pick a fund because some random YouTuber said that it's a good fund. At least spend 30 minutes to figure out what you are buying, what are the other alternatives, what are the pros and cons and stuff like that. Check if the fund has an exit load, check the taxation impact, check if there is any lock-in period in it or not. And fifth mistake is listening to too many opinions. One friend says buy ABC mutual fund, it gave me great returns last year. A YouTuber guru will say buy XYZ mutual fund, it is best for 2026. And your uncle will say mutual funds definitely not, because they lost their money in 2008, and they will say FDs are the best. Get some basic education yourself through my videos. Maybe you can subscribe to the channel if you want to keep learning, and then just take your own decision and start. And as I said before, you can watch this video here to find mutual funds yourself without any opinions. See you in this video. Bye bye.